Welcome to Unfiltered Finance. If you're tired of the financial illusions and ready for the brutal math, you are in exactly the right place. Let's dive in. In the spring of 1720, Sir Isaac Newton, one of the smartest men in history, invested in the South Sea Company. He made a quick profit, but then the ultimate FOMO hit. He bought back in at the absolute peak and lost £20,000. That's over $3 million in today's money. Newton famously muttered he could calculate heavenly bodies, but not the madness of people. Fast forward exactly 300 years to November 2021. The global cryptocurrency market hit a staggering $3 trillion in total value. Millions of retail traders suddenly thought they were financial geniuses, leveraging their life savings into digital monkeys and dog-themed coins. But then, gravity returned. By late 2022, the market didn't just correct, it violently imploded, vaporizing $2 trillion in months. Multi-billion-dollar empires like Terra, Celsius, and a $32 billion exchange called FTX vanished overnight. How did this happen? It wasn't just bad luck. It was a structural inevitability built on Wall Street's favorite poison: infinite leverage. Technology evolves, but human psychology never upgrades. Both bubbles were driven by exactly the same economic principle. It is called the greater fool theory. The idea that you can buy an overvalued asset simply because a greater fool will come along and buy it from you at an even higher price tomorrow. But the 2021 crypto bubble had a terrifying twist. The biggest fools weren't just retail day traders in their basements. They were institutional hedge funds, multi-billion-dollar lending desks, and sophisticated venture capitalists. They engineered a labyrinth of synthetic liquidity that guaranteed mutually assured destruction. This is the anatomy of a modern financial bubble. And it all starts with absolute silence. Every boom and bust cycle begins in the stealth phase. Imagine November 2022. Bitcoin is bleeding at $16,000. The media declares crypto officially dead. Retail investors are traumatized, nursing massive losses, swearing to never touch it again. But out of the spotlight, smart money begins its work. Hedge funds, family offices, and deep-pocketed whales start accumulating. They don't buy on public exchanges like Coinbase or Binance. That would spike the price. They use over-the-counter or OTC desks. They execute massive block trades directly with miners or distressed sellers, quietly soaking up all the available supply in the market. Legendary macro investors start taking 1 to 2% portfolio positions, viewing it as a high beta hedge against fiat debasement. Because smart money knows that crypto doesn't pump itself. It is a highly sensitive proxy for global liquidity. They are front-running the Federal Reserve. When the global M2 money supply contracts, crypto dies. But the moment central banks signal a pivot to cut interest rates and pump liquidity, the cycle resets. Slowly, the price starts to creep up. It hits 20,000, then 30,000. The stealth accumulation is over. We transition into the awareness phase. The broader financial institutions take notice, and the narrative abruptly shifts. Suddenly, the world's largest asset manager, BlackRock, with its $10 trillion in AUM, files for a spot Bitcoin ETF. This is the ultimate institutional stamp of approval. And it sets the stage for the most dangerous mechanism in finance. Wall Street isn't content with just holding an asset and waiting for it to go up. They want yield. They want efficiency. So they build the leverage machine. A complex system designed to turn $1 of actual capital into $10 of purchasing power. Here is how institutional crypto leverage actually works. Let's say a fund owns exactly one Bitcoin worth $40,000. In traditional finance, that capital is static. But in crypto, the fund deposits that Bitcoin into a centralized lending platform. The platform holds the Bitcoin as collateral and loans the fund $32,000 in stablecoins. An 80% loan-to-value ratio. What does the fund do with the $32,000? They immediately buy more Bitcoin, driving the market price even higher. Then, they deposit that new Bitcoin to borrow again. This vicious cycle is called Rehypothecation. One real Bitcoin has now magically created a chain of paper Bitcoins. The liquidity is a complete illusion. Enter Three Arrows Capital, or 3AC. At their peak, they managed $10 billion in assets. They were considered the smartest guys in the room. But their strategy wasn't genius. It was just maximum cross-collateralization. They borrowed billions from lenders like Voyager and Celsius without posting proper collateral, using their elite reputation as a shield. Meanwhile, those lending platforms needed to pay retail depositors a ridiculous 20% annual yield to attract their funds. To generate that 20% yield, the lenders took retail deposits and handed them straight to highly leveraged hedge funds like 3AC. The entire ecosystem became a massive Jenga tower. Everyone owed everyone else billions of dollars, backed by the exact same assets. As long as the price of Bitcoin kept going up, the collateral expanded and the music kept playing. But leverage is a double-edged sword. It pushes prices up artificially fast, but it forces selling even faster on the way down. And when the music stops, there is absolutely no chair to sit on. The stage is now perfectly set for the mania phase. Welcome to the mania phase. It is early 2021, and the Federal Reserve has flooded the market with 0% interest rates. The M2 money supply has expanded by 26% in a single year. Retail investors, armed with stimulus checks and locked at home, flood the market. The greater fool theory goes into overdrive. Rational valuation models like discounted cash flow are thrown out the window. Who needs a PE ratio when a JPEG of a pixelated punk is selling for $7 million? Herd behavior takes full control. The market transitions from an asset class into a religious cult. You aren't just an investor, you are part of a community. Dissenting voices are silenced with acronyms like FUD, fear, uncertainty, and doubt. By the 2022 Super Bowl, crypto exchanges are spending millions on television ads. Larry David and Matt Damon are telling millions of Americans that fortune favors the brave. This is the textbook blow-off top indicator. When your taxi driver, your barber, and A-list celebrities are telling you to buy an obscure altcoin, the smart money is already quietly heading for the exits. Institutional whales begin distributing their heavy bags to eager retail buyers. The market capitalization balloons past $3 trillion. But beneath the euphoria, the structural foundation is rotting. The leverage machine is stretched to its absolute physical limit. Funds are borrowing against highly illiquid, speculative tokens that they themselves created out of thin air. It is a closed-loop system of synthetic wealth. Everyone is rich on paper, but paper wealth is just a hallucination, waiting for a catalyst to break the spell. At the absolute peak, the illusion of infinite wealth creates monstrous distortions. Take Terra Luna, for example. In early 2022, it grew into a $60 billion ecosystem. It promised a stablecoin, UST, that magically paid a 20% yield on the Anchor protocol. How did it pay 20% in a world where US Treasuries were yielding barely 1%? It was heavily subsidized by venture capital and newly minted Luna tokens. It was, by definition, structurally unsustainable, but Wall Street funds, blinded by greed, poured billions into it. They treated this 20% yield as a risk-free rate. They leveraged their clients' funds to farm this magical yield. This is the fatal flaw of modern finance. Risk doesn't disappear. It just gets hidden in complex algorithms and layered derivatives. When 3AC, Celsius, and Alameda Research all hold the exact same illiquid tokens and use them as collateral to borrow from each other, they aren't diversifying risk, they are concentrating it. They have created a single point of failure. The total open interest in crypto derivatives hits astronomical highs. Millions of retail accounts are trading with 50x or even 100x margin. This means a mere 2% drop in price will completely wipe out their entire account. The market is standing on a landmine, balancing on a tightrope, blindfolded. The only thing keeping the system alive is the constant, uninterrupted flow of new, cheap liquidity. But thousands of miles away, in Washington, D.C., a man named Jerome Powell is about to flip the switch. The era of free money is coming to a violent end. March 2022. The U.S. inflation rate hits 8.5%, the highest in 4 decades. The Federal Reserve panics. They embark on the most aggressive rate hiking campaign in modern history, raising the Fed funds rate from 0 to 5%. The cost of capital explodes. Quantitative easing turns into quantitative tightening. Liquidity is sucked out of the global financial system like oxygen from a burning room. Crypto, being the most speculative asset class on Earth, is the first to suffocate. The flow of greater fools abruptly stops. Retail investors, squeezed by rising groceries and rent, have no more spare cash. With no new buyers, the price naturally starts to slide. And in a highly leveraged system, a small slide is a death sentence. May 2022. The catalyst detonates. Terra Luna's algorithmic stablecoin, UST, loses its $1 peg. Panic ensues. To defend the peg, the Luna Foundation Guard dumps 80,000 Bitcoin onto the open market. It doesn't work. Within a week, a $60 billion empire hyperinflates into absolute zero. But the death of Terra Luna wasn't an isolated event. It was the spark that ignited the cross-collateralization powder keg. Remember 3AC? They had massive exposure to Luna. When Luna went to zero, a multi-billion-dollar hole was blown straight through 3AC's balance sheet. And remember, 3AC had borrowed from everyone. Lenders assumed they were safe. They were wrong. The massive web of synthetic liquidity suddenly turned into a web of toxic debt. The Jenga tower wobbles violently. The underlying collateral isn't just dropping, it's vanishing. The contagion has begun. And the biggest players in the industry are about to fall. The moment 3AC realizes they are insolvent, they don't tell the market. They try to trade their way out of it, taking on even more extreme risks, but the market knows. Lenders like Voyager and BlockFi, who gave billions of unsecured loans to 3AC, suddenly issue margin calls. Give us more collateral, or we liquidate your assets. But 3AC has no collateral left. In June 2022, Three Arrows Capital defaults. The domino falls, and it strikes with devastating force. Lenders realize their safely collateralized loans are backed by absolutely nothing. Voyager Digital files for Chapter 11 bankruptcy. Celsius Network, which held $10 billion of retail money, freezes all withdrawals. Due to extreme market conditions, they tweet. Translation? We gambled your money and it's gone. The illusion of the 20% APY shatters. This is the terrifying reality of cross-collateralization. Fund A owes San B owes Bank C, and Bank C owes retail. When Fund A defaults, the entire chain implodes simultaneously. Because crypto operates 24/7 without circuit breakers, the unwinding is vicious and instantaneous. Smart contracts execute liquidations ruthlessly, dumping collateral onto already panicked markets. The selling pressure becomes self-fulfilling. Bitcoin crashes through 30,000, then 25,000, then 20,000. Every major support level is crushed by forced liquidations, but the worst is yet to come. Because hiding in the Bahamas is the biggest fraud of them all, a ticking time bomb worth $32 billion. November 2022, the final boss of the contagion. FTX, one of the world's largest crypto exchanges, run by the media darling Sam Bankman-Fried. For months, SBF had positioned himself as the savior of crypto, bailing out bankrupt companies. But it was all a facade. CoinDesk publishes a leaked balance sheet of Alameda Research, FTX's sister hedge fund. The shocking truth is revealed. Alameda's assets aren't in cash or Bitcoin. They are mostly in FTT, a token created out of thin air by FTX itself. Worse, SBF had secretly transferred $8 billion of customer deposits from FTX to Alameda to cover their trading losses. When Changpeng Zhao, the CEO of rival Binance, tweets that he is selling his FTT holdings, a modern digital bank run begins. Customers demand their money. $6 billion in withdrawal requests hit FTX in just 72 hours, but the vault is empty. The money was spent on venture investments, political donations, and Bahamian real estate. FTX halts withdrawals. Days later, a $32 billion behemoth files for Chapter 11. It takes exactly a week for the JP Morgan of crypto to be exposed as a massive, uncollateralized Ponzi scheme. The blow-off top is complete. The market goes into freefall. Bitcoin plunges to $15,500. Hundreds of thousands of retail investors lose their entire life savings. The leverage machine has finally eaten itself alive. We have entered the capitulation phase. The total crypto market cap sits at $800 billion. $2.2 trillion of wealth has been incinerated. The media, which once praised crypto founders as visionary geniuses, now paints them as criminals. Sam Bankman-Fried is arrested and later sentenced to 25 years in federal prison. Su Zhu of 3AC is arrested at an airport in Singapore. The founders of Celsius and Terra face severe legal consequences. For the retail investor, despair sets in. The Discord servers go silent. The Twitter profile pictures change from laser eyes back to normal photos. A generation of young investors learns a brutal, expensive lesson in counterparty risk and the dangers of unregulated margin. Trust is entirely broken. Regulators swoop in, launching lawsuits against remaining exchanges, classifying tokens as unregistered securities. The prevailing sentiment is that crypto is a failed experiment, a scam, a casino that has finally been shut down. Volumes dry up. Volatility hits historic lows. The market trades sideways in a miserable, boring chop. To the untrained eye, the industry is dead, but to a Wall Street analyst, this silence is deeply familiar. It is the sound of weak hands finally letting go of their assets. The system is reset. And so, the cycle completes itself. The house of cards has fallen, but look closely at the rubble. The underlying blockchain protocols, Bitcoin, Ethereum, never actually stopped producing blocks. The technology functioned exactly as coded. What failed was the centralized human layer, the greedy lending desks, the fraudulent executives, the extreme rehypothecation. The crash of 2022 wasn't a failure of computer science. It was a failure of human nature. It was exactly the same hubris that ruined Isaac Newton in 1720 and Wall Street in 2008. We constantly invent new, complex financial instruments, believing that this time is different. But the mechanics of greed and leverage never change. As we sit in the quiet despair of the bear market, a subtle shift begins. The Federal Reserve, facing a slowing economy, stops raising rates. The M2 money supply stabilizes. Out of the spotlight, in the absolute silence of the stealth phase, the smart money returns. OTC desks see quiet, massive block buys. Asset managers file for new ETFs. The cycle is a loop, hard-coded not in the blockchain, but in the human brain. The bubble will inevitably return because there will always be leverage, and there will always be a greater fool. This video is for informational and educational purposes only, not financial advice. All investing carries risk of loss. Do your own research. If you value the brutal truth over financial illusions, then hit subscribe today. To see how this math applies to your next move, click the video on your screen. I will see you there.